some product changes I'm talking about is like integrity came and went. If you're dabbling, like you finally may have felt comfortable using them and then they shut down 2 seconds later.
If we're looking at people's cash flow, is probably the most common one. We can see people are saving $100 a month, but their income is 500 grand. There's probably a clear indication that they need some advice around that.
This idea that we'll scope out commissions because it's better for you long term almost locks them into being a client forever, which is a huge conflict of interest anyway. So yeah, I hate this model.
Too far in, and once you start, you really can't tell a client that they're too complex. So you may end up doing far more work than you bargained for it.
If someone's around for the next 20 years, like some businesses we've been talking to is they're dabbling, they're trying, bringing it in-house and then working, okay, is it the individual advisor that's not working? Okay, maybe we need to swap another advisor in and out and then try again. And okay, if it's still not working, okay, maybe it's not them, maybe it's the business.
Oh, for God's sake, it was me all along.
Hey there, Phil Thompson here for another episode of My Risk Advisor with Trent Bacon. Hey Trent, how you doing?
Very well, how are you?
Great. So today what we're going to be talking about is the state of play of the insurance advice market. So what's going on? So advisor ratings have got plenty of great data. So we're going to dive into a bit of the data, what's the state of play, and then we're just going to talk about, what are we seeing in the market from our point of view. So let's start off talking about the state of play in terms of how many advisors do we have in the market, how much insurance advice is being written, what does that all look like? So talk me through some of that.
Yeah, so at the end of the 2024-25 financial year, there was about 15,500 financial advisors registered.
And that's down from like 24K or something like 5 years before
that.
Yeah,
at its peak before the FASTA exam and that all registration, the PY stuff.
Yeah.
So probably off the back of that was the peak just before that. So everyone got themselves registered so they didn't have to do their PY.
I think it's also, I think a whole bunch of accountants who needed to get registered, had a limited license, all accountants thought there was going to be an amazing gravy train, became, advisors, and then with the education standards, stuff this. What are we doing? I'm an accountant. I need to still be an accountant.
Yeah, let's just stay in our lanes.
Yeah.
So when talking about risk, end of 24-25, still that same financial year, 6,358 advisors wrote at least one new insurance policy.
And the math on that is just a bit over a third. It always takes me a little while to get the math. So just over a third writing at least one policy. That's crazy.
So where it gets more interesting, though, is the breakdown of the top half of the market. So of 50% of the total new business written, 589 advisors wrote that.
And the top quarter is 185 advisors just writing the top quarter. Now, I think, I don't know if advisor ratings goes into the data too much, but, the way our numbers at Sky is I am the advisor writing all the business here at Sky based on what AR data would be getting, because insurers only ever see my name come up. That's why they all think I'm a hero. But I don't do any of the advice. So it is a bit skewed. And some of the other larger firms do the same thing. A lot of people go under one code. Just makes it easier for management from administrative stuff. So there's one login. Makes it easier. Insurers are getting better with like multi-login, still being able to see the one code. But I do think it's probably a little bit more than that. But it wouldn't be the full 15,000 people doing the policy.
Yeah, what are we? We're probably 6 or 7 advisors at that time into one. I'd imagine there's at least another 4 or 5 large businesses, probably close to 20 to 30 large businesses doing something similar.
Yeah, I reckon we'd be one of the higher ratioed in terms of advisors writing into one code would be on the high end of those numbers. So let's call it maybe half of the business was written by 1,000 advisors, but under 589 codes. Now I'm pretty sure, I know advisor ratings, I've talked to Angus quite a bit, he's pretty good at his data, and I do think sometimes, after giving my preamble about all this, I wonder if they do look at the licensees that are writing that business and actually divide it by the amount of ARs in that license. So I wonder if it is actually true numbers after telling you how I don't believe it. I wonder if it's true at the end of the day. But anyway, regardless, half the business is written by less than 1,000 advisors. Like, it's crazy how small the insurance advice is. Also, like, the whole financial advice industry has come out of insurance. Like, it was born through insurance as well. So it's crazy that everyone's walked away from it. What do you think is kind of the main drivers of people walking away?
Just the hardness or how hard it is to give the advice. Underwriting's got harder. It's less profitable than what it probably has been previously. There's new insurers coming to the market, so it just adds that extra complexity. So you now need to learn new PDSs, new policies. There's new terminology. Step and level are no longer step and level. It's just those sort of things.
Yeah, I think the other thing actually is like anecdotally, the people that I talk to about their business and what they're doing, I think everyone is looking at this like this intergenerational wealth transfer and the opportunity that has for advisors to manage wealth. I think that's why wealth management is much more sexy, because there's huge opportunity there. And if advice has to go up in terms of the advice fees, which it has been going up astronomically, then how do you charge that level of fee that you need to run a sustainable business? It has to be to people who have got money to pay those fees. And so that's why, it's going up that wealth curve, and the everyday Australian who needs to get insurance in place are kind of being left behind because they don't have the wealth to pay the $5,000 fees that, the average advice fee is. So I think there's also that as well. But yeah, you talked about like product changes and stuff. Talk to me a bit more about what are the product stuff, because people listening to this or watching this, they will have, they may be insurance advice specialists, but they may be generalists. So they're kind of dabbling in and listening in to kind of stay somewhat relevant with insurance. What has happened over the last few years?
Yeah, so you've got your income protection IDII changes where they've reduced down the income protection benefits and what they do. So you've still got the old policies that were written pre-October 21, and you've got the new ones that have come in. So being able to compare those, what's the difference between the price? What are you actually giving away? Are you putting a client in a better position or worse position by cancelling it, even though you're saving potentially 20, 30, 40, 50% of the premium? Are they coming after you if something goes wrong for something you clearly probably should have kept? That's probably the big one. TPD changes that are upcoming, that's probably not something that's pushed us yet, but it will continue to push people out. With understanding what's going on with that and all the changes and the struggles they've had around those claims.
Yeah, and I think the requirement that we've got as advisors, we've got to know our clients. That's pretty easy. Every advisor does that well. But it's knowing the products when it comes to insurance, and these are all like legacy products. Like if you haven't done insurance in 5 years and you're looking at agreed value, and you're like, especially if you're fairly new, and you go, what the heck does agreed value mean? You've then got to go and research and work out what that means. Some insurance policies where they call it, like I think Integrity used to call it Indemnity 36. That was actually super helpful because they helped you realise if it was a legacy or not a legacy. But you read that, what does Indemnity 36 mean? A lot of this knowing your product when it comes to insurance, if you're not doing it a lot, becomes even harder, entry into advice when it comes to insurance. The other thing that is very different, like if you wrote insurance premiums 5 years ago versus now, like the average premium for clients is going up significantly. Now, AR data has those numbers. The issue with those numbers, they're from APRA. They get it from APRA is we don't know if the new business premium is because the clients are aging. And so, if historically 5 years ago the average client was 30, but now it's 40, those premiums are just naturally going to go up. But as we've seen, we do insurance all day, every day. Premiums are going up. So, what are the average premiums that AR data have?
Yeah, so we've got them here. Income protection in 2018 was just a touch under $3,000 per year for just your income protection. In 2024, that's closer to about $4,700. Yeah. So a fair jump there. All the other insurance policies are a little less. Trauma's actually come down. Which is cool. Everything else has trended upwards slowly, but income protection is your big one that's gone rapid.
Yeah, and this is why I say, the data is hard because APRA just group everyone together and they just go, all right, the total amount of new policies and the total number of premiums set up is A and B. And so advisor ratings just go, well, the average premium needs to be this. That makes a lot of sense. But APRA don't. I've looked at a lot of these APRA stats and their Excel spreadsheets that they give out. They don't actually talk about the average client age that are going to getting insured. So for us in our data set, this is way over our average premiums that we're seeing in our business.
Yeah, and some of it could be attributed to the last 12 months that trauma's come down. It's going, well, cash flow's got a lot tighter for most households, so maybe trauma's being reduced, not taken out anywhere near as much.
Yeah, exactly. Yeah. It's talking about new business premiums, but are we writing a $200,000 trauma with a new $100,000 trauma policy? That's a good point as well. Other things that are changing is like duration discounting. Now we will do a whole whinge fest. Well, I'll whinge. You'll be a bit more reasonable about duration discounting. Quickly, TLDR. What is it? And why is this creating more difficulty for advisors to?
Yeah, durational discounting is basically their upfront discounts. So if you buy a policy today, if you try and buy the same policy the next year versus holding your policy this year, you're actually going to be paying less by taking out that new policy. The same will happen year after year. So it's usually around a 5 to 6 year window for most insurers where their premiums might be discounted 20% over those years, and it's slowly coming off.
Some of the insurers, they disclose it in their quotes, which is good. One of the insurers in the past didn't have any information on it, but now they've added it to their advisor guide. But you've got to work out, they've literally split it over like 3 or 4 tables, and they're all added together. And it's like, you've got to get a math degree just to understand how it works. And one of the insurers, it's like 1.5% discount coming off every single year that you hold the policy. That frustration where most advisors aren't, like if you're dabbling in insurance, you don't know about these duration discounting or these upfront discounting until you re-quote your own client 5 years later and you go, the same insurer can give me a 40% discount on what I can get today or whatever the number is. So I think that just creates so much more frustration for the generalist advisors. And so people just getting out, even specialists are just like, it feels like a bit frustrating. We're tussling with this.
Yeah, if a client can go speak to a new advisor and quote exactly what they have currently with the same product that saw you 2-3 years ago potentially, and they're saying, well, why am I paying higher fees when I can get the exact same thing from someone else? Where's the benefit for the current advisor that's looking after it? We're forcing ourselves to have to look at it, review, and probably send it somewhere else, to be honest.
My words, not yours, but the insurance industry is forcing us to churn, which is this crazy back to the future. But the other thing, anecdotally is I think maybe a cause of the drop is the products. So, some product changes I'm talking about is like integrity came and went. If you're dabbling, like you finally may have felt comfortable using them and then they shut down 2 seconds later. Things like PPS, there's product innovation. So they've got a profit share account, which is great, and understanding their mutual model. Products like NEOS, their platform. So they're not an insurer, they're a platform. And what does that actually mean if you're kind of dabbling in this space? So talk about kind of those product kind of innovations. We want product innovations, but sometimes it does cause a bit of confusion.
Yeah, talking about profit share with PPS with clients, if you're not talking about it every day, it's pretty hard to figure out, especially for a client. They're talking about their insurances, they're talking about paying money, and then you're trying to tell them how much money they're going to get back from it. It's just going to be awfully confusing for them when you might be talking to their partner who has not the same arrangement, and they're like, well, where's my money? So there's that sort of stuff. But integrity comes and goes. If you wrote a few policies with integrity and now your clients are coming back saying they've got letters that they're now with AIA, their premiums are going up 20-30% potentially, well, where's the consistency? You're going to lose faith pretty quickly.
And I think if we move on to the business models that we're seeing, so, Sky is like, we are a specialist business. We do insurance only. So there are a whole bunch of different business models we're seeing. I'm sure, people will reach out to us and say, hey, you didn't talk about, what we're doing because we're doing something really funky. Awesome. Reach out to us. Let us know because we'd love to hear what different business models are. But let's just briefly talk about like the pros and cons of each of those business models. So, obviously there's no cons of our business model, but if we were to think about maybe some, what are the pros and cons of a business like ours?
Yeah, it's for clients, we're not giving holistic advice. So there are multiple areas that we're seeing with the client by getting their information and going, well, they probably need advice with that. And we're not able to give it to them because we're risk only. So we've got to refer it out or it just goes begging. So if we're looking at people's cash flow is probably the most common one. we can see people are saving $100 a month, but their income is 500 grand. There's probably a clear indication that they need some advice around that, but we're not giving it. We're referring that out, or it's just going begging.
Yeah, and that's what we expect our clients to be proactive. We offer, hey, is this an area that you want help with? We'll let you know who to go with. But I was in a meeting with a referral partner Monday, and they were asking, what happens with like asset allocation with a super fund if you see a client sitting in cash on their default super fund, their industry fund, are you going to give them advice on that or not? And we just said, look, we are insurance only. We will look at the insurance within their default cover, if they've got any cover. But if we see it all sitting in cash and it's $300,000, and we all know that's probably not a great thing for their long-term, wealth creation, we won't make a recommendation, to do that. Now, we still have an obligation to consider the broader impacts of our advice and how that impacts, but our clients have asked us to specifically scope it out. So we understand that is a con of our model. But talk to me about the pros. Give me the good side of the Sky business model.
Yeah, we're able to do the same thing every day. The clients know what they're going to get from us. We're able to scale and have all the processes sorted out, but we're also able to speak to the insurers and potentially get better deals through underwriting. There might be better pricing, all those sort of things that come with writing scale and being probably in the top 3 or 4 good books for most of the insurers.
And I think, for any advisor out there dabbling in insurance advice, like the insurance companies give us better pricing than they give you. It doesn't sound nice, but that they like us more than them. But it's not that they give us a higher commission. They're not allowed to do that. So what they do is they go, all right, we want our premium practices who we know can deliver really commercially great outcomes for our business as insurers. What's a way we can entice a Sky to recommend us more? Well, we'll give a 5% discount on all of their clients, or a 10% discount on the premiums, which the general market don't get those things. And underwriting terms, things like that people talk about, well, is that unsustainable, loading waivers and all of these things. We can discuss the pros and cons of all of that, but a premium discount for a firm that's completing at 90% applications and delivering a large volume, our clients get a better outcome than the general advice client. So that is one of the major pros that we don't talk about too much. It feels a little bit icky that, hey, if you come to us, you get a better premium than if you go down the street with someone who's kind of dabbling in insurance. But it is a reality of the market at the moment.
Mind you, we get paid less too because it's commissions off the actual premium.
Yeah, so. True. Yeah. They have high premiums for their clients and get paid more. But that's fine because our clients benefit. So the other model that we see, some people look at, is having a risk specialist within a broader, multidisciplinary firm or a holistic advice firm. So talk to me about the pros and cons of that.
Yeah, so the pros that I've never worked in a business like this, but I can imagine the pros are something like, your client stays within the business, so it's aligning the wealth goals with the insurance goals. So we're able to do that, and you're able to get the insurance person that's specialising it to make sure that they're making the correct recommendation when that's level of cover, right product, right features, all that sort of stuff, rather than having that holistic advisor that's going, I'll go with that insurer because that's the one I'm typically going with. They're able to make that direct recommendation based off everything they have there.
Yeah, and there are some cons to it as well. Talk to me about some of the cons.
Yeah, I would imagine that they're probably neglected the most, that risk advisor. If there's one advisor amongst, say, 10 holistic advisors, there might be really good processes built out for those holistic advisors giving wealth and all that sort of stuff advice. But that risk advisor might be there plugging away all day, doing the insurance applications themselves, dealing with the underwriters. And there might not be that automation and build out that, good advice firms and, advice firms really want to have to be able to scale.
Yeah. So anecdotally, the conversations I've had conversations with firms that it's worked for and conversations that it hasn't worked for. Now, to be fair, most of my conversations is the risk is in those firms who and they just they feel like the ugly cousin. Sometimes it's like the accountants get all the love, or the holistic advisor get all the love, but the risk, it's kind of the advisor can do it all because it's kind of like all you need to do is submit an application. It's probably undervalued in terms of its understanding of the complexity of insurance advice. I think the broader advice market think insurance is quite easy, and it's kind of the lower value. That's the easy work, just submit it and it'll kind of go through underwriting. And that's where those firms that aren't investing in that area of the business are struggling to retain those team members because they don't feel like they've got the support from the whole business as well. But there are other people I know who they really lent into it, but they're more like a group of self-employed advisors, and that group have said, actually, we'll hand it all to you, and you're our guy, and it's been more of a weight off everyone else's shoulders, being able to just handball it to the one specialist. So, yeah, it can work. There's pros and cons. So the next one is like holistic advisors doing it. Like, we're holistic, so we should holistically offer insurance advice. Talk to me about the pros and cons of that.
Yeah. Pros are the advisor gets to keep it in-house. They know exactly what their wealth goals are, what their insurance goals are, and basically put it all together and go, what is outweighing what? Right? Are we going to pay 10 grand in premiums to have the perfect insurance, or is that going to ruin what our wealth goals are, and finding that happy medium? Being in control of everything, which as advisors, most people want to be in control. Half the reason why most people got into the job, I dare say.
Yeah.
And cons is obviously, that dabbling part, not knowing exactly what's right for the client. You got to keep up to date with all those different things that are changing all the time.
Yeah. I mean, we do it all day, every day, and there is a lot to keep up with. Underwriting changes. Imagine having to understand all the superannuation, like tax changes that are legislated but yet to be come into effect, or the tax changes that are being announced but they may not actually go through legislation. Being on top of that, having those conversations with your clients, as well as all the other conversations you have to have around underwriting and pricing changes, that is a difficult thing. Now, something we actually didn't have it on a list, but I'm going to add it and throw it in now, is the fee-for-service advice business who scope out commissions. Talk to me about the pros and cons of that.
Yeah, so your pros are the clients are going to get a better price for their premiums for the life of the policy. If you're scoping out the commission, just saving them about 20% of their premiums for the life of the policy, and you're getting, or the advisor is getting covered by charging that initial fee. So it's all up front, everyone's happy, but the major con is that advisor doesn't want to have to deal with that insurance policy in 2-3 years' time, or at all, because every time they pick up the phone to talk about that insurance policy, they're losing money unless they're charging a new fee, which most advisors don't really want to be doing if you're just changing bank details or increasing or decreasing slightly. So often those clients become, absolutely unloved, and they don't have a home.
Yeah, and it's fine if they maintain ongoing holistic advice fees with the firm. Great, we can still manage this and look after you forever. But this idea that we'll scope out commissions because it's better for you long term almost locks them into being a client forever, which is a huge conflict of interest anyway. So, I hate this model. Because I fundamentally have seen so many clients who are just left as lepers that no one wants to touch, because unfortunately the business model at the moment is insurers won't touch them. Insurers won't manage their policies because they don't want to be seen to be giving advice because of the ridiculous nature of our legislation and the way it's built, which I don't believe that should be true. Insurers should be able to help their policyholders increase or decrease, but they don't. And so advisors setting this up, scoping out commission, is effectively either locking them into an ongoing service with them forever, which is sure great for their business, but a massive conflict, or it's setting them up for that initial cash, savings. Yes, they save long term, but the likelihood of their life changing and needing to adjust some things, maybe if they're 55 and they're only going to decrease over time, they can probably do that. But if they're young clients, I think I hate this model. I think it really shouldn't be around anymore.
Yeah, and you couldn't give these book of clients away half the time. No advisor wants to take them on.
No, all the specialist firms, we get asked to take on books that have got commission free, and we just say, no, you made your bed, you lay down in it and serve your clients because you made that commitment to them, you've got to serve them. So I get very passionate about it. And other specialist firms are doing the same thing, exactly the same thing. So the next business model is holistic advisors kind of like doing simple cases or like high value cases, like premiums need to be X amount before we'll do it, or referring out. Talk to me about the pros and cons of that.
Yeah, so your simple end, all right, I just need to do a life policy, could be really great. You get the commission uplift and away you go. If that application goes awry and you don't really know what you're doing there, it might become a bit of a mess and you might end up, head underwater and too far in. And once you start, you really can't tell a client that they're too complex.
Yeah.
So you may end up, doing far more work than you bargained for it. If that higher end, getting that extra commission is great. But again, are you giving that correct advice if you're only doing it for those smaller number of cases? You're getting the right levels of cover, the right features, and those sort of things.
And it's also sometimes the difficulty of that model is that if you have a minimum commission you need to receive, like I don't believe advisors will influence the advice to get that commission at all. I don't believe that's a thing. But the thing is, if only half of it completes because you're getting declined for your income protection and disability, and then does that pricing model then fall over if half of it gets declined? Does it fall over if all of it gets declined? Like that's kind of sometimes the questions I have with advice firms who are talking with us and trying to have some partnership models. Is that's my question to them is like, what happens if your disability benefits fall over?
Yeah, where do you get out basically? How do you know it's going to be under, let's call it 10 grand of commission if that's what your line's going to be? Is that you figure out on an income basis and things like that you know that's what it's going to be? What if your client has loadings, exclusions, that sort of stuff? Or as you said, it's not going to get income protection. You've already committed to doing their insurances, but you're only able to get their lump sums. If that doesn't meet your 10K, well, do you then ship it out to another advisor? How does that leave your clients? All that sort of things to consider.
Yeah. All right. The next model is if an advisor, a holistic firm, they're referring all their risk out to a specialist firm. What are the pros and cons of that?
Yeah, pros is they don't have to do the advice. It's plain and simple.
Yeah.
Do what you do well, and don't do the stuff that you don't want to do. So it's and your client still gets the benefit and they also have the need. So covering that need. That's the major one. The downfall is you don't have control over that advice and what it looks like potentially. Yes, you may be able to work with the firm and say this is what the sort of things we're looking for, and make sure that firm is aligned with your thoughts on the risk. But if your holistic goals and your wealth goals are saying this, and we need to save $10,000 every year or every month to reach our financial goals, and then the insurance advisor says actually you need $15,000 per year of insurances, well, that's going to ruin your goals, and you're going to have to go back to the drawing board and who's right, who's wrong, who's holding the bag at the end of the day.
Yeah. And the other con is at the end of the day, the clients may just choose not to go ahead with multiple service providers. And so you may build a great wealth creation plan and the client's on track for 3 years, but they didn't actually execute that insurance policy, and then something happens, claimable event, their wealth goals are no longer on track, and so I don't think you're necessarily too exposed because you've made that referral, and on reviews, if you're a holistic advisor and you're reviewing the cover and you're making note of it, actually making note, not just a file note, tuck it away, but actually having a conversation, hey, these are important, then you are protected. But it is on the client to then go and engage that specialist firm that's being referred to.
Yeah, it might take 3-4 months potentially to get through the wealth advice and get your budgeting and everything panned out. Does the client really want to then go, I've got to go through and to complete a fact find to do my insurances? Take another 2 or 3. Hopefully yes, but sometimes you'll find clients that won't want to commit to that again for at least another 12 months.
Yeah. The next business model is a joint venture. So a wealth firm setting up a joint venture with a risk specialist firm, or however it looks, setting up a new entity, and the clients are owned by that entity. Talk to me about the pros and cons of that.
Pros, you're getting paid for it, most likely. I imagine if you're setting up a joint venture, you're making sure that it's profitable for you and the new business you're joining. That's the main thing. You're keeping that revenue in-house, or at least part of it in-house.
Yeah.
The downfall is you're married to that business now. You're locked in. You've signed the documents. It's going to take a fair bit to get out of that joint venture if their service isn't what you're considering, if the advice isn't in line with what you're looking for as well.
Yeah, and the other thing is, you can't just pick it up and move as easily. Like just a straight referral relationship, you can test that out, for a small period of time. And to be honest, these joint ventures, they often start with just a simple referral and then transition. And so it does mean like if the joint venture business if they leave or they transition away from insurance advice, then that becomes a bit of an issue. So you are married, 50% of marriages end in divorce. And so I would actually probably imagine more than 50% of JVs end in divorce as well. So
They're having to hold in wealth and sick times.
All right, there is one talking about like neglecting the insurance need. That is an option. What's the pros and cons of that?
Yeah, the pro clearly is just don't think about it. You similar to referring out, don't have to think about it. It's water off a duck's back potentially. Obviously, the con is your client doesn't have insurance, or you're not even considering their need for insurances, and if something goes awry, you're on the hook. Where if you're referring it out, that's that case of we don't do it, but you should speak to these guys because they specialise in it and there's a direct need for it. If you're just flat out forgetting about it or
neglecting just scoping it out. If you scope it out and go, hey, that's not what we do, all good, then yeah, there is a issue there. The other thing is it's a compliance risk, like a massive compliance risk. If we got a requirement to consider the broader needs of our advice, and so insurance only scoping out wealth is somewhat, we think about this in terms of the compliance risk. It is a lot less risky because we can very clearly articulate that our fee is much lower than a holistic plan. If a holistic plan is what you want and what you need, then we'll refer you out to someone who will do that and do it all for you, or we'll partner with them, however it looks. Just straight out scoping out insurance within a holistic advice plan. If you're doing mainly retirees, a few pre-retirees, maybe it's reasonable. But if you're dealing with younger clients, even like 10 years from retirement, 20 years from retirement, then you're taking on a big risk.
Yeah, and all it takes is one event. Someone has a car crash and passes away, and their family's selling their house and all that sort of stuff, and you haven't considered their insurance needs. That could be tens of millions of dollars potentially.
Yeah. The last model that I want to talk about, and I get a bit fussy about this one, but the general advice model. So what are your thoughts? It's on the rise. There's a lot more insurance being set up via general advice. And there was a lot of advice firms who were talking about partnering with general advice and referring out. So what are your thoughts on this, pros and cons?
Yeah, pros, it's seemingly easier. You don't have to do a statement of advice. You can get the advice done quicker. Whether that's good or bad, we'll take it or leave it. The cons is obviously you can't take the client's personal circumstances into consideration. Are the clients actually getting what they want, what they need, or are you just setting up $1 million of life and TPD for everyone because that's what's written on your ads and that's what they've come for? Is that going to actually meet the needs when push comes to shove later on?
Yeah, and for me, I have always been okay with the long-standing general advice businesses. I think there is a need for it, and I think the ones that have been around for a long time, they understand where the line with personal and general advice is very clearly, and always steer clear of it. The ones that have come out of personal advice and just transitioning to general advice is a huge risk factor for me, and I think that's where a risk comes for that business transitioning their personal advice clients into general advice clients, because how's the client going to know the difference? The big con is there's no consumer protections, until you can prove that they did provide personal advice instead of general advice. With a statement of advice, if the advisor's done something wrong, dodgy, even just a simple, careless mistake, they're still liable for that advice and still liable for those things. So there is consumer protections that the clients are missing out on going to the general advice. And for me, when I talk to personal advice providers, wealth firms who are looking at partnerships, I do question sometimes when you are going from a personal advice model to your clients and then you say, but go and self-select with this, it sometimes feels a bit funny to be like, when it comes to general insurance products, I feel a little bit uncomfortable. There aren't really great brokers in home and contents or car insurance. Like we would love there to be a network of brokers. We could say, go to this person, they will broker the insurance for you.
It's not the meerkat.
Or loans is another great example where we don't tell our clients, just go on to finder.com.au and just find the cheapest loan and then just apply through there. We would recommend a broker who's going to help provide advice and recommendations on the loan and why, and that's why I'm a big believer in personal advice for insurance advice. I do understand that the desire to move into general advice. But I think that's where insurance companies should fill that void. They should be able to sell their own products. But it is an interesting topic, and I'm sure we'll talk about it over time as well. And I'm sure we'll interview people who are doing general advice, how they're doing it, what are they doing well, and ask them robust questions about, how are they making sure that they're not crossing that personal advice line. So I think that's a good understanding of the market. But if someone's been listening to this and they're like, okay, I understand the market's down. I understand the different models out there, whether it's someone looking at doing risk only or a holistic advice firm, what should people be thinking about after this discussion?
Yeah, multiple different angles. If you're a business and you have clients, you need to be considering what your client's needs and how you're going to achieve that. Is it sending it out? Is it doing it yourself? Hopefully it's not neglecting it. But one of the many models that was spoken about could work for your business, and it may not work for one business and it works for the next because of your client base and how you operate. If you're an individual advisor and you want to get into risk advice, speaking to different risk advice businesses or individuals that work at those businesses, speaking to the actual advisors that do it day to day rather than maybe the business owners, you might get a better perspective on what happens. It might not be as...
You're saying I won't be as honest as our advisors will be.
They might give you a different perspective potentially. I doubt it at Sky, but other businesses you may. There's not too many layers of management at Sky to see too far down the pipeline. Just understanding what's available out there and how things work. And plenty of different advice firms are doing different things. So I wouldn't jump into any new arrangement without looking at multiple different angles and speaking to other businesses that are doing different things.
Yeah, and it depends on your business life cycle as well. I'm thinking like for someone who is like close to retirement or trying to exit their business, they're probably unlikely to move into a JV, a joint venture, because that's that's really successful after 5-10 years and not short term. They may want to keep doing it themselves, and so accumulate as much ongoing revenue as possible to then maximize the value of their business. If someone's around for the next 20 years, like some businesses we've been talking to, is they're dabbling, they're trying, bringing it in-house and then working, okay, is this working, is this not? Is it the individual advisor that's not working? Okay, maybe we need to swap another advisor in and out and then try again. And okay, if it's still not working, okay, maybe it's not them, maybe it's the business, So if you're going to be in business for the next 20 years, you can kind of try different things. We've got other firms who are using general advice referrals and then wanting to use us as well as options for their clients, and that works for them. And so, I think different courses for different horses. Is that the saying? I know you're a farming guy. Is it? Different horses for different courses. Didn't I say that?
It's all the same
different
thing.
Courses for horses. Hey, there's different things for different people. And so, I think just dabbling, understanding the market, as you said, reach out, talk to as many people as possible. And if risk is such a small part of your business, don't overthink it. Pick one whatever's easier for you other than neglecting, and just go down that path until it really needs to you need to focus on it. Well, I think this has been a good chat. I think looking forward to interviewing different people with these different business models as well, and hearing about like the wealth firms partnering with these models and the advice firms who are doing the risk in these models. So it's going to be great, leaning into a bit more about the business models. If you did enjoy this, feel free to reach out and connect with us. We'd love to hear what you liked and also what you didn't like. I'm kind of a little bit of a psychopath and love hearing the negative things or the areas of growth, shall I say, Trent. Thanks heaps for joining us, and we'll catch you in the next episode.